ahead for the Wall Street amid the market chaos?
The most important thing is to realize how to diversify well. And when I mean that, I don't mean just the sectors, I mean the countries, I mean the currencies.
Will Fed's balance sheet explode? What's the consequence of that?
We're likely to see more depreciation and excess printing.
Should the investors no longer worry about the traditional value metrics?
Bonds and stocks compete with each other. 1% interest rate, that's the equivalent of a PE almost of 100.
Thank you, Ray, for joining our Top Investors Talk. It's such a familiar scene that you sit in the same study room and share your insights to the world in the past 6 months. First of all, how's your quarantine life so far?
Well, quarantining for me has been excellent. I'm lucky that I have the circumstances that I have. And then, of course, I've seen what it's been to so many other people. And so that's a little bit heartbreaking. But for me, it's been fine.
What's ahead for the Wall Street amid the market chaos, including COVID resurgence, election uncertainties, etc.?
There are three main categories of things that are going on. You referred to a political one. Mm-hmm. So there in the United States now, there is a clash, a great clash between rich and poor, left and right, and different ideologies. That's a political clash. There's also a lot of printing of money and creating of debt. So with central banks printing the money to finance that debt, to distribute the money in this time. And then there is, of course, the change in the world order, the evolution. Those three forces are operating simultaneously. I think the most important thing is to realize how to diversify well. And when I mean that, I don't mean just the sectors, I mean the countries, I mean the currencies. I think a lot of investors are concentrated in what was good over a period of time, and I think things are changing. So as we think about China, for example, China is emerging as really a great market, but a lot of investors are underweight in China. So diversification is going to require investors to think about going where they're not as used to going, and that's been true through history.
U.S. stock is now in a sideways period when investors have very divergent view on the market outlook. What's your take on that?
The dynamic that exists is that the Federal Reserve and the European Central Bank and the Bank of Japan will create a lot of money to finance a lot more government debt on any movement down in any economic activity. They used to call it the Fed put, but anyway, there is that particular dynamic. That depreciates the value of money and the value of bonds. In other words, if you produce a lot more debt and a lot more money, then the debt you own is not going to have a good return, and the money you produce is not going to have as much value. And so I think that that is the primary important thing for investors to pay attention to. They don't pay as much attention to the value of the money, the value of the dollar, the value of the currency, the value of the renminbi, typically, as they pay attention to what stocks they own. And yet the bigger influence will be that monetary policy. I think we're at a position right now where we're likely to see more of a depreciation and excess printing and excess debt creation in the three major reserve currencies.
How do you perceive Fed's new policy framework?
The Fed is doing what destiny demands. They say we will have an inflation target that's a bit above the 2% target. Recognize that they always will have to choose between growth and inflation, and they're going to do what they've always done, which means like if growth or economic conditions are not adequate, they're going to raise their stimulation, and if inflation goes higher. What's happening in the meantime, when you produce a lot of debt, that can't go on forever, because all that debt is somebody's asset that has to be, that you think, am I going to get an adequate return? And so then you could get the selling of that debt by bondholders So that would mean they'd have to print more. So they're setting themselves up for a difficult circumstance that's sort of kicking the can down the road because they need to, because immediately everybody needs that money. And so that's the path. That is what's driving monetary policy. The raising of the inflation target to above 2%, or allowing it to go above 2%, is just a technical way of saying that.
In a market effectively run by the central bank, should investors no longer worry about the traditional value metrics such as PE ratio?
Think about it this way. The bond yield has gone to almost nothing in the United States and next to nothing in Japan and Europe. And so think about what that means in a PE sense. That means almost an infinite PE and so on. Bonds and stocks compete with each other. If you had a 1% interest rate, that's the equivalent of a PE almost of 100. I'm speaking figuratively as present value calculations, but similar. So what the central banks are doing is putting cash into the markets and then driving up those PEs. It's of course correct that when you look at a PE, you look at, well, what is the earnings and the cash flows that I'm going to get from stocks, and what is that worth? But that competes with bonds and the like, and so don't get stuck on traditional PEs as a guide.